Welcome to AION Powerhouse, the deep dive. Today, we are not arguing about which model is smartest. We are pulling apart a single number, leaked out of the most anticipated IPO filing in tech, that quietly reprices every AI company being funded right now, but 44%.
Right.
That's Anthropic's gross margin. I mean, the most advantaged AI company on Earth, $47 billion in run rate revenue, and it still books a margin a SaaS founder would call a crisis. The software lived at 80%. Today, we argue that this one number, not the valuation headline, is the truest test of whether artificial intelligence is a software business at all and what it means for the gross margin line on your own P&L.
Yeah, this really isn't just some accounting debate. Gross margin is the line that decides what kind of business you actually are. Let's just baseline it for a second. Gross margin is, the share of each revenue dollar you have left over after paying the direct cost of delivering your product.
Which is your COGS, right?
Exactly, your cost of goods sold, COGS. And for traditional software, that COGS was practically nothing. I mean, it was just some basic server hosting. That is exactly why software margins historically sat near 80%, and it's why the public markets gladly paid 10 to 20 times revenue for those companies.
Because every new dollar of revenue dropped almost straight to the bottom line. You had zero marginal cost.
But let's look at the data that completely shatters that paradigm. On June 1st, 2026, Anthropic filed confidentially to go public. And we should be clear up front because this is a confidential S1. These figures are reported and leaked by sources. They're not audited public disclosures yet.
Right, but the reported top line is it's staggering.
Staggering. They're hitting roughly $47 billion in annualized run rate. And for anyone not living in the metrics daily, run rate is just taking that last month of revenue and multiplying it by 12. They are at an absolute massive scale. Claude Code alone jumped from $500 million to $8 billion in ARR, annual recurring revenue, in roughly 8 months, which is arguably the steepest adoption curve we've ever seen in enterprise technology. I mean, the valuation whispers are north of $1 trillion off a $65 billion private round.
Yeah, everything looks incredible until you hit the gross margin line. And it's about 44%, not 80, low 40s. The single most computationally advantaged company in the world with, frontier models and the best engineers on Earth is delivering a fully loaded gross margin that would get a normal SaaS founder fired.
And that breaks the software multiple paradigm entirely. I mean, at 44%, more than half of every revenue dollar you make it's eaten before you have paid a single salesperson, marketer, or software engineer.
Because the thing you're selling costs money to run.
Exactly. An intelligence model answering a query costs real money every single time it fires. That is fundamentally not a software cost structure. So the operative question this filing forces on you, as a founder or CEO listening to this, is not, what is Anthropic worth?
Right.
The question is, if the best capitalized AI company on Earth can only reach the low 40s, what exactly is the gross margin on the thing you are building? And honestly, have you ever actually measured it?
Well, the immediate reflex I hear from founders, like the comforting frame they fall back on is always margins improve with scale. Everyone knows that. We've been trained by 2 decades of SaaS to believe that, scaling up cures all your unit economic problems.
It is the default assumption. And in AI, it is highly dangerous because it's only half true.
Yeah, so let's walk the actual cost structure to break that frame. In the first quarter of 2026, for every dollar of revenue, Anthropic was spending around 71 cents on compute. Let's define the terms here quickly, because this is where unit economics just bleed out. Compute at this stage is primarily inference.
Which is the ongoing cost, right?
Yes. Inference is the electricity and GPU cost of actually running the model to answer a user's request. It fires on every single query. You have to separate that entirely from training, which is the massive one-time capital expenditure cost of building the model in the first place.
And when 71 cents of every revenue dollar goes strictly to inference compute, I mean, your business is barely keeping its head above water on the core product. Now, there is a good news piece to this, which the bulls rightly point to. That ratio was projected to fall toward 56 cents in the second quarter.
Wow. Yeah.
Yeah, they are optimizing workloads, deploying custom silicon routing queries better. So the efficiency curve is genuinely bending.
But hold on, you have to look at the forward commitments. Because this is the catch you have to hold in your head as a founder. Yes, the per query cost is dropping, but the aggregate costs are contracted to scale up enormously. We are talking about roughly $200 billion committed to Google over 5 years.
$200 billion?
Yeah, and over $100 billion committed to Amazon over 10 years. They are locking in the compute that dictates their QGS years in advance. at frontier prices.
Which forces a complete reframe of the asset class. An AI company is not a software company with a temporary cost problem. It's a business that buys raw compute wholesale and sells refined intelligence retail.
Oh, that's a great way to put it.
Right, and the spread between those two, the wholesale input and the retail output, that is your gross margin. And it is structurally thinner than software because the core input is a metered commodity that you do not control the price of.
Let's plain English the asset classes for a second. Mature SaaS gross margins are around 80%. If you look at the broader AI applications cohort right now, they're running closer to the low 50s on average. And at the absolute frontier where Anthropic lives, you were in the low 40s.
And the tell that this is a structural reality and not just some, transitional phase is in the usage dynamics.
Yeah.
Even as that per query cost falls from 71 cents toward 56, the total spend continues to rise. Why? Because every new capability you ship invites more usage.
Right, if you ship an agentic coding workflow, that uses 10 to 100 times more compute than a simple chat interface.
Exactly. More usage means more inference. More inference means more CODS. You don't grow your way out of the cost. You grow into it.
Which means Wall Street is definitely not going to value this with a software multiple. You have to value this more like a refiner or a utility with a very strong brand.
Precisely. You take a raw commodity energy and silicon, you refine it into a higher order product called intelligence, and you just hope your distribution and brand allow you to capture a spread.
So let me give you a framework to hold in your head to make this operational. Think of Anthropic and, frankly, your own company if you're building on top of these models as a tenant, not a landlord. You've built a beautiful, high-margin looking business inside a building you don't actually own.
Okay, I'm following.
The buildings, the compute, right? The data centers, the GPUs, the power grid.
Yeah.
AWS, Google, NVIDIA, those are the landlords. And every month, no matter how good your software product is, the rent comes due.
I like it, but let's tighten it. Because a normal tenant's rent is fixed. You sign a commercial lease, you pay 10 grand a month, and if you cram 50 more employees into that office, the rent stays exactly the same.
Mm-hmm.
What makes the AI dynamic brutal is that the rent here scales with how well your business does.
It's totally metered.
Metered, exactly. The more customers use the product, the more queries fire, the higher the compute bill. It is a tenant whose rent goes up every single time they acquire a new customer. So it's not just rent, it's a usage-based revenue share that you pay to the landlord on every single transaction forever.
Yeah, that is the sharpened version. You are a tenant paying a usage-based rent to the owner of the compute, and that rent is your KGS. A 44% gross margin means roughly 56 cents of every dollar you make walks straight out the door to the landlord.
So what is the operator lesson here? If you're a founder, how do you actually survive that?
You have to buy down the rent. Let's look at a concrete example. Say you run a legal tech platform. You charge $50 a month per user. Before AI, your gross margins were like 85%. Then you integrate a frontier AI model to summarize case files. Suddenly, your power users are uploading 100-page PDFs every day.
Which is incredibly compute intensive.
Very. And if you send every single page of those PDFs to the most expensive, heaviest frontier model, your compute costs will exceed that $50 subscription in a week. Your gross margin goes negative.
Which is exactly what we are seeing in the private markets right now, by the way. Startups are scaling their revenue while secretly bleeding cash on every new enterprise contract.
So how do you buy down the rent? First, you route the work. You do not send a basic document classification task to a frontier model. You route that easy work to a cheaper, highly distilled model that costs a fraction of a cent. You only wake up the heavy, expensive frontier model for the complex legal reasoning. Second, you cache aggressively.
Right, caching is huge.
If 3 different lawyers at the same firm ask for the summary of the exact same public ruling, you serve a cached answer the second and third time. You do not pay the landlord to generate the same intelligence twice.
And strategically, you have to own more of the workflow. The companies that win this era aren't the ones with the flashiest wrapper. They're the ones who quietly become part landlord by owning proprietary workflows or human-in-the-loop data assets that insulate them from the raw compute cost.
Yep.
You build a product so deeply integrated into a customer's daily operations that they just cannot easily rip it out. You need that lock-in to maintain the pricing power required to cover the rent and still keep a margin.
Well, let's steel man the bear case here, because you need to hear the ruthless, disciplined argument. Raw financial gravity. Point 1. Costs scale roughly linearly with usage. In traditional software, serving your millionth user is virtually free. In AI, serving your millionth heavy user costs nearly as much compute as serving your first.
And point 2 is the trap. We really need to explicitly warn every operator listening about this.
The 70% myth. Yes, you are going to hear optimists and investors throw around a 70% margin number as proof that AI margins are totally fine and improving. Let's define the difference between gross and inference margin right now to kill that myth. That 70% is inference margin.
Right.
Inference margin is the margin on the compute line alone, measured in isolation, typically on highly optimized workloads. It is not your fully loaded gross margin. Gross margin includes everything it takes to actually deliver the product to the customer, the server hosting, the data pipelines, the human-in-the-loop QA, the whole stack. That fully loaded number is the roughly 44% figure we are talking about.
Conflating inference margin with gross margin is a fatal financial error. And frankly, it's usually an error made intentionally by people trying to sell you something, whether that's software or secondary shares. You cannot run a business or pay your employees on inference margin. You run it on gross margin.
Exactly. And a point 3 of the bear case is the raw cash burn. At their current burn rate, Anthropic is reportedly losing on the order of $40+ billion a year on a cash basis. The relentless pace of model competition forces you to keep spending billions on the next frontier model before the last one has even come close to paying for itself.
As someone who watches capital markets, $45 billion in cash burn is not just a high burn rate, it is a structural distortion. It's the GDP of a small country being incinerated just to stay in the race. That is the strongest form of the bear case. But look, let's weigh the honest bull rebuttal without hand-waving, because the other side is real too.
Yep.
The per query cost genuinely is falling. Moving from 71 cents to 56 cents in a single quarter is a massive operational achievement. Hardware and efficiency gains compound over time. As open source and mid-tier models get good enough, you can route 80% of your traffic to those smaller models, bringing your blended KGS way down.
And enterprise switching costs are rising. Once a Fortune 500 company has its secure data enclaves, its compliance routing, and its custom tooling wired into one model family, leaving is highly expensive. That grants pricing power. You can hold the line on your subscription price even as your underlying compute costs drop.
So the bull case isn't crazy, but here is the honest synthesis. The bull case requires the margin curve to bend faster than usage and competition push your costs up. That is an empirical race.
It's not a law of physics.
Exactly. Software's 80% gross margin was a law of physics. It was rooted in the reality of zero marginal cost to distribute code. AI's margin is not a given. It is a fight you have to win every single quarter. You have to plan your P&L like it's a daily fight.
So what do you actually do with this at your Monday morning stand-up? Let's make this highly operational for the CEO listening right now. Action item 1. Measure the number you've been avoiding. Calculate your real gross margin today. Put your inference compute, your server hosting, and all direct delivery costs squarely into KGS. Do not bury your compute spend in R&D just to make your gross margins look like a SaaS company for your board. If you have never computed this fully loaded number, that is your first tell that you are flying blind.
Second, track your inference to revenue ratio. This is the share of each revenue dollar eaten strictly by the compute required to run the model. Here's a rough rule of thumb for operators. If compute is eating more than a third of every dollar, meaning your ratio is below 3-to-1, and that cost isn't rapidly falling, you have a structural problem, not a growth problem.
Yeah, it's a huge red flag.
The industry average for scaling AI B2B companies sits around 23% of revenue eaten by inference. If your product requires calling a massive frontier model on every single keystroke, you will never fix your margins at scale.
Which leads to the third action item. Start buying down the rent right now. We talked about this. Cache aggressively. Route easy queries to smaller models. Batch your asynchronous processes during off-peak hours when compute is cheaper. And if you have the scale, negotiate committed use cloud pricing the exact way Anthropic did with their massive Google and Amazon deals.
To land the strategic thesis here, Anthropic's filing is the entire industry's true gross margin made public for the very first time. And the message is undeniable. Intelligence is not free. Pretending it is will get you killed in the public market, and it will kill your own cash flow long before you ever get there. The roughly 44% margin is not a failure.
No, it's reality.
It is the honest, actual price of frontier intelligence today. But it demands a complete reframe of your business model. You are not building a software company. You are building a refinery with a brand, renting your most important, expensive input from a landlord whose meter literally never stops spinning.
Okay.
The founders who win this era will not be the ones who deny the rent exists. They will be the ones who engineer the rent down, who price their retail product to cover that wholesale cost, and who build the one thing a landlord can never repossess a customer who would never leave. That is the number that decides your future, not the trillion-dollar valuation headline, the 44%, and which direction you, as an operator, can bend it.
That's the deep dive. One number, 44%, and the whole question of whether AI is a software business hiding inside it. If this sharpened how you read your own margin, this is AION Powerhouse Signal over Noise. We'll see you in the next one.
That's your ION Founders Briefing. Stay informed every weekday. Subscribe now and download the ION app at aionpowerhouse.com.